everyone. Welcome to our first discussion of the income tax class. This is chapter 1. We're getting into our material here where we're going to lay some foundation a little bit about personal income tax. So our topic this semester is really personal individual income tax. We are going to cover some business aspects of that a little later, but we're not dealing with anything at the state level, local level income tax. We're not dealing with sales tax or payroll taxes or any of those things as well. So somewhat limited in our scope so that we can actually get through the material. I'm sure you'll agree by the time we've gone over some of this stuff that there's plenty of detail and plenty of things to remember without getting into any of those other items as well. So jumping right in here, what I'll do is just kind of go over the slides. These are the same slides that you have in the learning module, and then you can either take notes along with it. I'll add some additional explanation, point out the parts that I think you need to focus on, that sort of thing, give you my take on this material, which is really a outline of what is in the textbook as well. So you've got the textbook, you've got the PowerPoint, you've got my explanation together. Use them as you would like, start and stop as you like, however makes sense, works for you to learn the material. So a little background. There was an income tax for the Civil War, temporary, went away, came back later, found to be a problem with the Constitution, which limited the ability of taxation if it wasn't based on, allocation by the states. And so the 16th Amendment in 1913 allowed us to have an income tax that fit the Constitution. So just a little bit about what we're talking about, the scope: 153 million individual income taxes returns. That stayed fairly constant. The data comes out. There's always some delay in the data from the Internal Revenue Service to show us what the results are. So that was consistent, about the same as 2017. Most, by far, are filed electronically. The real goal was to get to 90%. We're close to that. There's always going to be some things that can't be filed electronically, but we're getting very close to all of them being filed electronically. And it's the largest amount of the budget or source of income for the United States. So $1.5 trillion comes in through that. So it is the biggest by quite a ways source of revenue for the U.S. government. So a couple of different ways that income taxes can be kind of calculated. All right. Typically, what we end up with is a taxable income, and then we multiply it by a rate. Now, if that rate is different depending on how much income you have, or how much taxable income is referred to in this as the tax base, then it is progressive, typically, meaning it goes up with the more income. So that is how our system is designed. So you pay one rate if your income is, and that's what we refer to as tax brackets. One rate for first 10,000, let's say, and then you pay a different rate for everything after that. The point to remember is that the rate for the first 10,000 still applies to that 10,000. You're making 200,000, you still pay the lower rate on the first 10,000, and then on the next you pay a different rate, and on the next different rate. So you have to, if it's different rates, then you've got a different structure, and you see the rates in the textbook, and you can look them up anytime as well, just by Googling that in the online. Now, other income taxes where the tax rate, or it doesn't matter. Example, for instance, is Pennsylvania income tax. Your state income tax, and I told you we weren't going to really talk about state income tax, but just as an example, you pay the same 3.07% regardless of income. So on the first 10,000, on first 100,000, on all of the income. There is no difference depending on income. So it is a proportional tax structure. It is the same. And then regressive tax structure means that as your income increases, the tax rate still changes, but it goes down instead of up. All right. And so the example is Social Security tax. We will learn there's a maximum that you pay certain Social Security taxes on, which really isn't our focus except for the fact that it's reported for a lot of folks on their regular 1040 form. It actually drops to zero when you reach a certain level of income. And there's a reason for that, but that's considered a regressive because it goes down instead of up as your income gets higher. So when you hear people talk about taxes, and taxes, there's probably no topic that more people talk about and think they know about and don't. Okay, so it's an interesting. There's a lot of stuff that floats around about what is actually in the tax law or not. A lot of people write about it. A lot of people, sometimes they get it right, sometimes they get it partially right. That's usually the case. And then, but when you hear them talk about it, it's often we refer to as in either one of two terms. And we want to make sure that we kind of have an idea what this means. Average tax rate just takes your tax that you paid divided by your taxable income. That's your average tax rate. Now remember, it differs, meaning if you pay a lower rate on the first 10,000 and then a higher rate on more, it's not going to be one of those rates. It's going to be an average of those, a weighted average based on how much of your income is in that tax bracket. So my average tax rate could be, say, 13.4% because I paid part of my income at the low tax bracket and some at the higher one, and it kind of averaged together. The marginal rate of tax is what is paid on the next dollar of income. That is always going to be a tax rate that you find on your table. So in the textbook, there's a table with the tax rates. It will be one of those. It'll either be 22 or 25 because when you're in that tax bracket, that range of income, any additional dollar of income that you earn, you will have to pay that percentage more in tax. That's what we call the marginal rate. So the example given here is that the 22% tax bracket for married filing joint couples, okay, starts at $80,250. So $850 first dollar when they make, if they make $80,251 instead of $80,250, they'll pay 22 cents or 22% of that extra dollar. So they only get to keep 78% of that additional dollar. That's what a marginal tax rate is. And that's what causes people to, that's how they make decisions. That's how businesses decide. That's how individuals decide that sometimes their behavior is based on what their marginal tax rate is, not necessarily so much on their average tax rate. They don't think about what they paid overall as much as they think, well, if I made the decision and took on an extra job, how much would I pay in taxes? That's the marginal rate. So this is the key. This is the key component of this chapter. This is the income tax formula. We start with income. We're going to broadly define income as basically anything that increases our well-being in many ways. It doesn't even have to be in cash. And then we have under the law, and basically the general idea of the tax law is all income is taxable unless you can deduct something from it or exclude it. Those are subtracted. So you start with everything, subtract out those things that are in the law that are allowed to be taken out. So basically, all income is taxable unless the law says it's okay to not. Okay, so you have to look for the areas where it's not included, all right? Or there's a deduction, and that equals our taxable income. Then we go to figure out, using the tax rates, or a tax table, the tax liability. And the tax table is simply an application of the tax rates. And that equals our tax liabilities. We subtract from that any payments we've already made. So you're constantly making payments through withholding by your employer. They take some of your money. You realize that on your each pay stub when you don't get what you thought you earned. And that is payments on your tax and any credits. So sometimes the amount you spend on something actually counts as you paying tax. That's a credit. And so we'll subtract that, and then we get either amount due or we get a refund, depending on which side is higher. That's what the tax return does. That's what the formula, how it works. So every year, individuals file a Form 1040. All right. That is, in 2018, we simplified that form and moved a lot of stuff off of that form into what we call the schedules, some which were on the 1040 originally and now they're not, and so forth. Some were already on schedules, but Schedules 1 through 6, and they simply explain numbers on, or give detail of numbers on the 1040, the different schedules. So sometimes you may not need any schedules for a very simple return, and for something that's more complex, you could use all of them. Okay? They all basically hope and work towards this tax formula. That is the end result. So, for most people, awful lot of their income comes from wages, tips, commissions, bonuses, all that type of stuff. It's reported right away. They get a W-2. This is their employer telling them how much they make. You're probably familiar with this document. You receive it. You take the information off that. You transfer it to your 1040. Box 1 is where wages and that sort of thing. Interest income, same idea. Transfers and gets reported to you at what you earned, and then is put it on the schedule. Unemployment compensation is taxable. Remember, just income of any sort, the first assumption is taxable unless excluded somehow. That's included. You get a report, 1099G. So you get this idea that that's what all these tax documents you receive. They're reporting from, in this case, the government, state government, which is who pays out the unemployment to you. This is how much you paid. It's also being reported to the Internal Revenue Service, who's then going to match that amount that you received based on what the 1099G says that the IRS's copy with what you report on your 1040. Subtract, and we'll talk about this more. The standard deduction depends on your filing status. For now, we'll just say that you're either single or married. $12,400 for single, $24,800 for married. We'll find out that there are more different options, more so in how that affects standard deduction in Chapter 2. But you could be head of household, you could be married filing separately, you could be a surviving spouse. Those are the other options. So that, for a very simple return, is the allowed deduction. You subtract that off, and that equals your taxable income on the 1040. And you can see those on a Form 1040. So we'll look at, go through this calculation of tax payments, and then take a look at the 1040 form. All right. Up to $100,000, you use the tax tables. And that's in Appendix D of your textbook, also on the IRS website. If it's over $100,000, then you use Appendix F or the tax rate schedules, which requires you to do some math and subtraction and all that kind of stuff. It's not, you won't get the same results. So for instance, if you use the tax rate schedules for income under $100,000, you may get a slightly different answer than if you use the tax table. Usually like $2 or $3 difference is all. All right, so technically you are supposed to use the tax tables, and that's the amount you should pay. I've never seen the IRS get to a bent out shape if you calculate using the tax rate schedules for lower income and we're off by $2 or $3. They just don't, that's just not their concern. All right. Tax payment, then you know how much you got. Your W-2 not only tells us what you earned, it also says this is how much was paid, how much the employer took out of your check and paid for you. So obviously that's very important information as well. There's other credits that can be considered. We will cover those in detail in Chapter 9. But this is the idea that the 1040 is settling up. Okay, you've been paying all along. You calculate what you earned for the year. Now that you have all the information for the whole past year, you see how much you should have paid. You compare it to how much you did pay along with any credits. And then you either owe the IRS or you're going to get a refund. That's what the 1040 tax return is designed to do, is basically see where you are. All right? Compared to what you paid in, what you actually owe versus what you paid in.